Thank you for joining us. A quick bit of information about who we are. Holborn, as a company, we started just over a quarter century ago. We're the second largest independent financial advisory globally. We have licenses and offices in 18 different jurisdictions spanning the globe, managing several $billion. We are the winners of numerous international investment awards, and we advise clients from many high net worth individuals to family offices and even European royalty. A little bit about your hosts. I am Matthew Taron. I'm a senior associate with Holborn. I am a cross-border wealth management expert with advanced qualifications in investment as well as taxation. I am both South African and UK qualified, having passed my level 4 chartered exams in the UK through the Chartered Institute for Securities and Investments. On the webinar with us today is a colleague of mine, Jeff Dorr. He's also a senior associate with Holborn, having over 12 years of experience in the investment, trust, and finance sector. Jeff specializes in helping South Africans, individuals, and families move and protect their wealth offshore. He is also our in-house training and technical specialist as a result of his deep industry knowledge and experience. And then joining us as a guest this morning, we have Andrew Wellstead. Andrew Wellstead joins us today from OWP, where he is the tax director. His previous experience includes big global names such as CMS. He was senior counsel with Anderson, as well as being director at Norton Rose Fulbright. He is a highly regarded South African tax practitioner with significant experience in a number of fields, including financial transactions, corporate transactions, restructuring, international tax, compliance work, and voluntary disclosures and disputes. So let's get started then with why we are here today and what it is that we are going to talk about. Now, in the ever-changing landscape, the risks to one's private and generational wealth becoming ever greater, the need to protect and structure wealth and investments against risks such as geopolitical risks, currency depreciation, regulatory investment restrictions, expropriation of funds, restrictive asset allocations, forced repatriation of funds, the high costs and performance fees of many South African fund managers, as well as excessive taxation, has made structuring and the protection of wealth of vital importance, particularly if you want to ensure that that wealth will still be around for the next or even future generations. So the aim of today's webinar is to look at some of the most concerning threats that have many of our high net worth individuals and family offices seeking a second opinion from us when it comes to protecting of their wealth from that ever-changing legal landscape, particularly from a taxation aspect. Building up to the budget speech, I'm sure many of you would have seen quite a few different press releases, and while many of these concerns may not have been directly in the most recent budget speech, they have been in the news on a regular occasion and almost certainly on the radar for SARS. So before we get started, I'd like to welcome Andrew, and if he can give us just a brief update on this most recent budget speech, which we're waiting to have approved. Andrew, welcome. How are you?
Very well, thank you, and thanks for having me. Very nice to be here.
So what is your take on the latest budget speech?
So just to give my perspective, because I think that's important, I'm a tax technical guy, and that's what I look for in the budget. I'm not an economist or anything like that. And what's interesting about recent budgets, it's interesting, but it's not surprising, is recent budgets have been very low on tax technical, okay? There's not a lot of tax tinkering. There's not a lot of big headline changes. Obviously, the VAT rate was a big headline change. I'm talking more about the kind of things that we get excited about. Tax rates are tax rates. But why is that? Well, things are pretty dire, and that's what came through from this budget. This was a tumultuous budget. The cancellation of the first budget speech absolutely shocked me. And I know that there are varying views. This is democracy in action, et cetera, et cetera. But my takeaways are as follows. The Minister of Finance is not an idiot. And he's certainly not looking to cause trouble or cause more instability than there is. And for him to consider even a 2% VAT hike, which is so politically fraught, tells you something. The fisc is under big pressure. Our economy is not growing. And, you can collect tax all you like and tax all you like. Without economic growth, you are stuck. We all know the endemic problems that South Africa has. We've got a tiny tax base, etc., etc. And one of the most interesting things that came out of the budget commentary for me was more and more people saying we have to focus on growth. What would you like the most? Obviously there's the contingent that's talking about basic income grants, and Parks Tower wants his BE fund. But in general, a much broader spectrum of people are saying economic growth. And that's absolutely critical. Absolutely critical. But the 2% proposed increase in the VAT rate and the hullabaloo that's followed have been very, very interesting. And what they tell me as somebody who advises clients on correct ownership structures is that the push for offshore structuring remains cogent and correct in my view. I think the election last year was a resounding success and went much better than I could. My kids live here. There are many things that as a South African I'm hopeful about. But you don't plan for the best case scenario. Well, you guys are better planners than me, but I think you guys will confirm. You plan for the worst case scenario, and if anything better happens, so be it. And the budgetary process and the potential fallout with the government of national unity, I don't know if you read the Sunday Times, but they're talking to the EFF now to try and get support for all of these acts. To me, it says nothing but good planning means slowly getting your assets offshore. You can live here, you can spend here, but the exchange control rules as they stand are the most flexible they've ever been. And nothing about the budget suggested to me that we need to stop doing that. In fact, I just want to read you a little quote, if I may. This is about our borrowing costs, and this is from the minister. Debt service costs will amount to 389.6 billion in the current financial year. This translates to 22 cents of every rand we raise in revenue. It is more than we spend on health, the police, and basic education. Okay. So our debt is out of control. It's nearing the 6 trillion mark. Our economy is not growing, and a budget's not harder to do than your household budget. We've got nothing coming in. We borrowed a lot and we spent it, and we don't have much to show for it. That's pretty dire. Okay. So for me, yes, it may have been democracy in action that the DA had a say. I don't know what happens to the government of national unity. What I can tell you from what I've just read is the economy is under pressure. We hopefully are committed to growth. Our foreign policy has always confused me. It seems to have 2 or 3 different threads running at once. That's not good. That's not good for growth. If we make growth the most important thing, things will turn around. But everything says to me, correct planning still offshore. Okay. So let me tell you a couple of other interesting things that came out of it. The grey listing. There's a lot of articles that say, was the grey listing so bad? For me, the grey listing was a catastrophe. I deal with people who want to invest their funds abroad, want to deal with a range of financial institutions, and it has made life so difficult and so impossible. And yes, it's a catastrophe. It makes our borrowing more expensive, et cetera, et cetera. So there was decent news about the grey listing, but could be spin, right? They said they've complied with 37 out of the 40 checklists, and there's 22 work streams going, and we're doing well on most of them. I wouldn't mind a date. I wouldn't mind a date this year that says we'll be off the grey list because we prioritize it and we see it as an absolutely key piece of growing the economy. I didn't get that sense, but at least it's there. It's in the budget. We'll see what happens with it. So the grey list is something that worries me. It makes it very difficult for South Africans to deal abroad. And if it's not I hope it's for a priority from what they said. As I couldn't really read into what they meant. Other interesting things, though, that people may have missed. There was a nice technical section regarding exchange control. And there is a recognition that the cross-border payment system has to expand. And what does that mean? That means getting away from the traditional bank cross-border payments, okay? So what they said is Reserve Bank is collaborating with the Prudential Authority to expedite non-bank access to the national payment system. Okay. So I think that means cryptos, right? What else could it mean? Crypto assets, as they like to call them, are a critical part these days of the financial world. Simply, whether you like them or not, and I know they're quite divisive, but a lot of particularly younger investors are interested in them, and things like the blockchain may change the way that our financial system works. Okay, and although there have been many task teams and investigative committees and things, we've never really moved. My interaction with crypto assets comes in predominantly through exchange control. Can I make payments abroad? Can I receive payments abroad? Can I invest? What can I do? And they've been singularly unhelpful up until now. Again, they didn't give like a real commitment to anything other than it's on the radar. But I think it's very, very important, because every single day I talk to, they're generally youngsters, guys saying, we're starting a business, we're doing cross-border, we can save bank costs, we can do it better, blah, blah, blah. And I have to tell them, I think you're breaking the law. So some clarity on crypto assets and crypto payments and how they're going to be perceived and what the licenses will allow people to do is absolutely critical. And I was very, very grateful to see that came out in the budget. Lastly, and this is maybe something quite small, but it's quite interesting for me. They've stripped away a lot of government incentives. There are some solar incentives, the most famous one being Section 12, capital B, capital A. That's gone, but they've kept capital B. So there is still a recognition that there will be tax incentives for helping businesses and households go off the grid. 12B is more aimed at businesses than households than 12BA was, but it's still there. A lot of people have set up funds through which they invest into solar, and you get the tax benefit as the investor. So that's still there, and that's still available. So, I mean, just to wrap up, the minister had nothing to play with, to be honest. I'm quite sympathetic to him saying he wanted a 2% VAT increase. It's almost like a technical oak, say, look, technical guy, what do you need to do? And he didn't think it through properly. I hope that the budget doesn't get too politicized. The economy is the most important thing, and in general, ministers have done the budget themselves. They've been responsible with it. If this becomes a point scoring exercise, it's going to kill it. But the economy is dire. Our messaging and our policies are multi-faceted, if I can put it that way. We need to decide where we are. And from what I saw and what I've always said, the shift needs to be foreign investment, grow the economy, grow the tax base.
Yeah, absolutely. I think that's going to be one of the key things that's going to have to come out of this budget. So let's see if things get approved or not, because it's really unprecedented territory. I fear what would happen if it doesn't get approved, what happens then next. And I think many people are under the impression that because the budget speech has happened, it is done and dusted, when in actual fact it's not. It still does need to be approved through Parliament. Anyhow, so South Africa, if we move on for the rest of this webinar, South Africa is a very highly, and many people don't realize that, but we are a very highly developed and well-regulated country. When it comes to our financial and banking sectors, we are arguably able to compete with some of the best out there globally. And we're never too far behind other jurisdictions such as the UK, Australia, many of your European countries, other highly regulated countries when it comes to financial innovation as well as regulation. So given global trends then, what is on the horizon for South Africa? So let's start with some of the concerns that have been brought up by many of our higher net worth clients and family offices. Well, to start off with, there's the UWOs, or otherwise known as unobtained wealth orders. Now, several countries, including Australia, Kenya, Mauritius, the United Kingdom, Ireland, Trinidad, Tobago, even Zimbabwe, have all introduced unexplained wealth orders. And in November 2020, South Africa went and also started to test the feasibility of doing the same here at home. And sure enough, in 2022, SARS issued a press release in line with the Financial Action Task Force when it implemented its own UWO in conjunction with its newly formed High Wealth Individual Unit. We then also have wealth taxes. And this is the thing, as Andrew was speaking of earlier, that need for greater tax revenues. So not only in South Africa, but globally, countries during COVID has led to renewed interest in terms of wealth taxes. And according to one of the recent PwC updates that I read, the number of countries that are now levying an individual net wealth tax has risen from 4 back in 2017 to 20 as of February this year. That's a significant increase. Countries such as Norway, Spain, Switzerland, France, Italy, Belgium, Argentina, Algeria, many more have some form of wealth tax. We then also have the scrapping of the exemption on foreign retirement income. Now in the US, Australia, some EU countries, most foreign pensions and annuities are taxable. In 2017, we saw the UK remove its foreign pension exemption, even including qualifying recognized overseas pensions, or QRUPs as they're called, which have become taxable in the UK. And surely enough, we now see proposals to remove the tax exemption on foreign pensions here back home in South Africa as well. Another proposed change is how collective investment schemes are taxed in South Africa. Following examples of, again, the UK, Australia, and the US, Hong Kong, Switzerland, South African Treasury last year published it in a discussion document its own proposals to tax or change the taxation of collective investment funds, using these countries as direct examples in their proposal. Thus, it's very clear to see from the international landscape where South Africa itself may very well be heading, given our past history of following international trends in financial regulation. So let's delve into these in more detail. And Jeff, if we can ask you to give us some insight on wealth taxes and where we may very well be heading in terms of that.
Thanks, Matt, and good to see everyone on the call. Sometimes we shouldn't be following global trends. Often South Africa decides to go a different direction in other sectors, and maybe sometimes we should do that with regards to our own policies. But Andrew, you paint a very clear picture, a very dire picture of the position South Africa finds itself in. No surprise, we're sitting with huge deficits. And when you look at what the tax revenue is going towards in terms of government spending, it's not surprising. And a question I actually had, which maybe we can come back to, is whether or not you think on that whole Laffer curve argument, if we've already reached the top, or if there's any breathing room at the top of it, where there's still some level of production that can be created and output that can be created through the tax side of things. My answer to that is definitely not. The VAT increase is going to hurt the economy over a period of time. Personal income tax increases, if they were to take place, hurts the average citizen. It stops them from spending. It puts less money in their pocket, less disposable income, less spending, less investment, all these things. So I too am sympathetic with our poor finance minister about the position he's in. And building up to the budget speech, the topic started floating around again. And in fact, I actually tallied it up, the number of times I saw wealth tax come out in different argument or different articles from Daily Investor, Biz News, of course, News 24, Daily Maverick, old Alec Hogg and Biz News talking about it as well. 48 separate counts of wealth tax being mentioned in some shape or form. So simply put, what is a wealth tax? Well, it's a levy or a charge on the total net value of your assets. Right? So that could be anything. That could be land that you hold. That could be investments, financial or otherwise. Interests in business, right? Your shareholding or your loan accounts that you've made to businesses. Savings accounts, term deposits, physical property itself, other assets, digital currencies, however they, continue to keep record of that. And, you know, as you mentioned, it's not out of the ordinary for South Africa to consider this. As you said, the OECD, or the Organization of Economic Cooperation and Development, quite a mouthful, has recorded that over 20 countries in the last 4 years have introduced some form of a wealth tax. Now, we've got to be clear, it's not a generalized wealth tax on your total net value of assets. Some countries have introduced wealth tax on certain forms of assets, interests in business or listed securities. But there is a growing interest from countries to start collecting revenue from this form of a levy. And it typically only used to be Europe. It typically only used to be your civil law countries, European countries like Spain, like Norway, Italy to a degree, France, but that has grown outside of Europe as well. And I get a little bit nervous when our commissioner starts to, you know, mention almost justifying how it could potentially come into play, that South Africa is not without its own wealth taxes currently. Almost to say introducing a new one wouldn't be that different. It wouldn't be that you know, out of kilter. If we think about our current wealth taxes, when we pass away, our estate is subject to something called estate duty. That's levied at a rate of 20%. When we purchase properties that aren't from an off-plan standpoint, or you're purchasing a property from someone, you're paying your transfer duty, and that sort of scales around, let's say roughly 6.5%. And then, of course, whenever we dispose of assets, any asset that is not for personal use, like a car or a boat or something of that form, that has a level of growth associated with it, we pay capital gains tax. And we've seen the commissioner and his various, let's say, analysts around him saying that these wealth taxes have been in place for a long time. South Africans are quite, you know, au fait with them, accustomed to paying them. So what would introducing a wealth tax actually mean? Well, I think it's going to have far-reaching consequences for your tax base. As we spoke about the concept of the Laffer curve, how much more tax could you possibly add to an economy before it becomes unproductive? I'm pretty sure we're at that point. Foreign direct investment becomes a thing of the past because no one is then willing to put their money into a country that looks at sourcing revenue on a source basis. Capital flight will definitely be a massive theme, if it isn't already, for most people and most businesses. But I think the bigger thing is, for everyone on the call, how does it impact you as the individual? Bearing in mind, we're already a very small tax base, carrying a very large tax burden. And we're paying taxes in line with developed countries. I mean, if you look at the World Bank's latest census, South Africa is the 13th highest globally taxed country for personal income tax, 16th highest for corporate income tax. The problem with that is the revenue, as Andrew pointed out, is going towards paying for our mounting debt, paying for an unsustainable social grant welfare system, and you know, let's call a spade a spade. I think we still have too large of a what do you call it, a public wage bill. You know, all of our municipalities and the ministers and the cabinets after that, and so none of that, or a very small percentage of that, is actually going into growing the economy. So coming back to all those impacts, now where does a wealth tax then, you know, sit, and who is it targeted at? It's not going to affect everyone, and they've been very clear on that. A wealth tax in the countries where it works is implemented from a very high threshold of wealth. So on a progressive basis, there is a very small percentage of the population that need to worry about this. So from an earnings perspective, according to SARS's data, if you're earning roughly 1.9 million Rand a year, you're in the top 1% of earners, and you are very, very much in the spotlight. I don't know if you guys have seen those silly comments. It said, oh, you know, if we introduced a wealth tax to the top 10 billionaires, they could easily cover the 58 billion shortfall, right? But best you believe those billionaires have an army of lawyers and tax practitioners that help them get their taxes much lower than the average South African relative to them. So it's not inconceivable, Matt, and that is the challenge. There's many unanswered questions, and I think one of the first questions is, what is the definition of the wealthy? Because there is no Income Tax Act does not have a definition for that. The Estate Duty Act does not have a definition for that. So they need to work on that first. What is their definition? How do they put finite measures in place for that? How would the levy work? How would they administer this? Now, the start of this has happened. Make no mistake, the start of this has happened with the high wealth individual unit that you mentioned earlier. That is where they're getting their data from. That is where they're starting to source information around this. And that will be the same task force that answers all those other questions. They're probably going to upset a lot of people in the process. And something like this would go into, you know, a decent amount of consultation. But should they introduce a wealth tax in whole or in part, that is a concern for most South Africans, because I say the larger impact is capital flight, foreign direct investment leaves. This impacts all of us. This impacts so many jobs. This impacts so many different areas of the economy. So whether this happens in whole or in part, the stigma of the conversation is that the government continue this rhetoric that transferring wealth is the answer. So your planning must, I mean, I keep banging the drum and my clients must get so frustrated at times. Your planning must involve conversations on how you can reduce the impacts of this in your future.
Thank you, Jeff. Brilliant. Andrew, do you have any personal views or professional views in terms of the wealth tax and how you think it may very well be implemented? I personally feel that a wealth tax won't be income-based, but it'll be generally based on, similar to estate duty, there'll be a value, and anything above that will be subject to wealth tax.
So, you know, and this relates to the Laffer curve that Jeff was talking about. In the budget, they said the following: raising personal income tax rates is likely to be inefficient as taxpayers make adjustments to reduce their tax liabilities. Higher personal income tax rates would also reduce the incentive to work and save, with potentially larger negative impacts on the economy. Okay. I think the part of the ANC that would like to implement a wealth tax renamed themselves the MK. So I don't think there's a massive support in the existing ANC for it. I definitely don't think the current minister is knee-jerk. And if it's true that economic growth is what they're after, the wealth tax is completely the wrong way to go.
Yeah.
I think they know that. You definitely can't introduce a wealth tax at times when exchange control is going the way it's going, because the capital flight risk, as Jeff said, is just massive. So me personally, I don't think it's going to happen unless there's some changes in the makeup of the government, which can happen. But the point that Jeff makes is the correct one. You don't plan for the best case scenario. You plan for the worst. So when you're planning, is it inconceivable that a wealth tax happens? Of course it's not inconceivable. It's very conceivable. On a balance of probabilities, no, but on a lower test, could it happen? Yeah. And as I like to tell clients, you must plan for the worst outcome. And a wealth tax is but one of the things that we're looking at in a worst outcome. And, you know, there's the hell-bent commitment to the Expropriation Act, to the NHI, never been explained how they're going to pay for it. Parks Tower's got 100 billion rand fund, apparently, when they're going to be paying for NHI. So politicians are politicians. They're saying what they're saying. Who knows what they do? Plan like there's going to be a wealth tax. You won't be sorry.
Absolutely. Okay, so then one of the other things that's been in the news very recently and has caused a lot of concern from investors is the recently published document or discussion document by National Treasury towards the end of last year. And these involve proposed changes to the taxation of collective investment schemes, or unit trusts as another name. So what has been happening there? So for those who do invest in investment schemes, collective investment schemes, unit trusts, some mutual funds, you should take serious note of the very seriously negative impact that it could actually have. The latest proposed tax changes on these schemes, there's a good chance that many of you have money in such a scheme, whether through a pension or through some other sort of investment vehicle. So what is it they would like to do? What is the proposed change, and what is this discussion all about? Well, as a bit of background, something that Andrew mentioned earlier, and both Jeff also spoke about, we can't deny that government is eager to collect taxes. There is a dire need. And trying to increase taxes from an ever-shrinking tax base is not very easy. It's been reported that something like, and Andrew, you probably know better statistics than this, but it's been reported something like 3% of taxpayers in South Africa contribute to around 76% of all personal income tax that's collected. So it's very much a skewed sort of environment. Now, the proposed change would then mean that capital gains, which used to be exempt in collective investment funds, would now be taxed as income in the hands of you, the investor. So what is a collective investment scheme? So a collective investment scheme essentially pools different investors' money together and then invests in assets such as shares, bonds, property, as an example. Now, these portfolios or funds are considered separate taxpayers, and they are classified as vesting trusts for the purpose of tax. Now, back in 2018, National Treasury then already expressed some concern over collective investment schemes, which in its view were generating profits from active and frequent trading of shares and other financial instruments. And that many collective investment schemes were allegedly abusing the capital gains tax exemption enjoyed by them through wrongfully classifying these profits as capital and not actually as revenue, which they were. Now, why and how did this come about? Well, simply because South African law does not really explicitly define what constitutes a capital gain versus ordinary income. So in the current landscape, under Section 25BA of the Income Tax Act, capital gains within a collective investment scheme is exempt from tax. And any underlying capital gain is essentially deferred until you, the investor, sell out of your or disposes of those units. Any non-capital income, such as interests and dividends, is taxed within the fund, unless it's actually distributed to you, the investor, within 12 months, in which case it retains its nature and gets taxed accordingly. Now, capital gains tax, as we know in South Africa, is taxed at a very different rate than, for example, revenue or income. And this is very important. In South Africa, it's a distinction with very significant implications for an investor within a collective investment scheme. Why? Because anything that is income in nature can be taxed at up to 45%, whilst anything capital in nature would be taxed at an effective rate of up to 18%. So a vast difference. And at the end of 2024, the collective investment scheme industry in South Africa was estimated to be worth around 3.8 trillion ZAR, or rands. So it's a very nice big pot from which to collect more taxes. So what is the concern? Well, the concern centers around amendments that have been proposed to the income tax treatment of those profits earned by those investment schemes. Now, amending Section 25BA to make, and this is the first proposal, to make them fully transparent, to be able to have a look through. And thus, any collective investment scheme would serve only as a conduit, with you, the taxpayer, then being taxed on any capital gains and incomes that flow out from that. And this is in line with similar investment vehicles in other international jurisdictions. So, National Treasury highlighted in its own document countries such as Australia, the US, the UK, Hong Kong, and Switzerland, all allowing for that full flow-through or tax transparency. Thus, by proposing that new tax regime under Section 25BA, it would, in actual effect, make them completely transparent, in line with international precedents, where investing in investment funds such as collective investment funds replicates the outcomes of what you, the investor, would have if you had invested in those underlying instruments directly yourself. So in simple terms, you, the investor, would be treated as if you earned that income and those gains and incurred those expenditures or expenses directly and thus taxed accordingly, even if that investment fund does not distribute that sort of income to you. So if the tax treatment of a collective investment scheme does become fully transparent, it means then, in simple terms, that taxation occurs at you, the investor level, and not only would result in these fees of investment funds becoming substantially more expensive. Why? Because for that full transparency and for that reporting, it would need a substantially complex reporting structure. One of the other downsides of that there is the issue that many fund managers would feel that you, or did feel that you, the investor, may very well be unfairly taxed based on the investment decisions that investment managers or fund managers make, rather than the activities that you yourself are doing. There was another proposal, and that proposal entailed a safe harbor rule. And there, rather than making everything just fully transparent and taxing you, the investor, on any profits or gains within the funds, the aim here was that you have a predetermined ratio, and that would deem what is capital and what is not capital. And the percentage recommended there was 33% by National Treasury. The problem with this approach, though, is that this could very well lead to fund managers retaining underperforming or undervalued assets, or avoiding the rebalancing of portfolios merely so that they can stay within that threshold so they do not exceed those turnover limits. The discussion document also proposed changes to hedge funds, excluding them from deemed capital treatment, as well as the disqualification of collective investment schemes from corporate rollover relief, something which apparently also, again, now receives a lot of abuse. So ultimately, no matter what view one takes on the matter, National Treasury has assured industry players that they won't act in haste, that they will give it full proper consideration and discussion with industry players. But due to the past abuse and incorrect reporting of many of these incomes as capital, and changing the tax treatment of a collective investment scheme is definitely on the radar, and something that I'm certain that we will more than likely see at some point on the horizon. So another thing apart from that that's also been proposed very recently is the changes to foreign pension income and the exemption that one currently enjoys, the scrapping of that. Jeff, if you can talk us or walk us through those proposed changes.
I will shortly. Coming back to your topic, Matt, it's we need to remember that going into these collective investment schemes is already post-tax. This is money that you've potentially sold a house. The post-tax amount's gone into the investment. Or you've received a salary, you've paid your PAYE, you've done your tax return, it's the post-tax amount going in. I mean, the impact on your net growth as those taxes become due and assessable each year, and the need for liquidity that you might not have because you're effectively growing your wealth. I mean, the implications really are, people need to consider that one. Probably of all the topics we're speaking about, I think people need to consider that one the most, because everyone here, including myself and yourself, we all have unit trusts. We all have those investments. This is going to be a big impact if it comes in any shape or form. But yes, the sneaky comments that were made in regards to taxation on foreign retirement income and the scrapping of the existing exemptions. I'm not going to spend too much time on this, but guys, basically how this works, many foreign-born people choose to retire in South Africa. Surprisingly, the number is quite high. Look, it's nowhere as high as, say, Portugal or Mauritius or Greece relative to the population. But it is still a material number. And this is part in, lifestyle is really good, especially if you've come down to the glorious Western Cape. Cost of living, incredibly cheap compared to Europe and UK and other places. They're typically using primary currencies, so even further cost efficiencies for them. But, and Andrew and I were talking about this just before the call started, a very favorable tax regime if you're stepping into South Africa or returning to South Africa. And one of the things that makes it quite a favorable tax regime is our laws fully exempt any income that you receive from a foreign pension fund if it was contributed to by yourself or the employer when you were abroad. So you're working abroad, you're working in the UK, and you're funding a UK pension, or you're working in Germany and you're funding a Serie A type retirement fund. Those are all exempt from tax if you draw down the income in South Africa, provided it was funded abroad. The classic example we look at is someone in the UK. And the reason we look at the UK is, so you've left the UK after funding and contributing to a UK pension scheme. You've moved or returned to South Africa, depending on your previous circumstances, and you're now drawing an income. First off, the UK and South Africa have a tax treaty, like South Africa has with many other places. And the tax treaty actually outlines that if you're a South African resident, it doesn't matter where your pension is coming from, it's going to be taxed here in South Africa, specifically between the UK and South Africa. And then onshore, you've currently got an exemption because of our laws. So in effect, very crudely, you're receiving a double non-taxation, right? Relief that you shouldn't be receiving. You should be taxed somewhere, right? And by the way, that exemption exists because when you're funding a pension abroad, unlike when you're funding a retirement annuity in South Africa, you're not seeing any tax relief on the money going in. So it's only fair that the exemption is your relief when you're actually receiving your income. So SARS have really highlighted this, and they're taking steps to rectify this. So we can definitely expect to hear more later in the year towards either the midterm budget, or possibly they'll wait and investigate further towards the next official budget. And we can expect, I say this with planning with the worst circumstance in mind, we can expect that this exemption is actually fully removed, and makes it certainly less favorable for investors. And that then asks the question, well, how many of those people would then actually look to retire here? And again, it's a bit short-sighted because it wouldn't only be the UK. There's over 26 countries, UK, Austria, Belgium, Denmark, Hungary, Israel, Italy, US, to name a few, that we would impact foreign-born nationals that decide to retire here. Our aim is actually to do a talk on this as we hear more and give more examples closer to sort of May time, so we can share that with anyone that's interested. But again, this rhetoric of making it unfavorable for people that are investing in the country, they're going to look at options where it's more favorable for them, and our economy will suffer because of that.
I think something also that's very important to point out with the proposal as it is at the moment is that it has specifically to do with employment income funded pensions, not with discretionary funds that you yourself have earned post-employment.
Yeah, absolutely. Absolutely. The existing exemption is all about occupational-based pension schemes. So there must be an employer-employee relationship. It is not that you have decided to take a lump sum of money and structure that into an international pension. That is something completely different.
Yes. Okay, so before I hand over to Andrew and gets his advice and his views on tax opinions, something which he's very, very familiar with, I always remember this one expression or idiom: SARS can't tax what's not yours. Hence why there was in the 80s and early 90s this big rush in South Africa to put everything into trusts, more recently putting everything into offshore trusts. And while there is some truth to that idiom, it is important to note that I think it was last year or the year before that Natasha Singh, who heads up the High Wealth Individual Unit, said that 40% of trusts in South Africa fall foul of regulation. So it is something that they pointed out they were definitely going after. And this is why when you're keeping abreast of regulatory changes, in the extremely complex and ever-changing field of tax and tax law, when it comes to protecting not only your personal but also your corporate wealth, from what many perceive and feel is the greatest threat at present, which is excessive taxation, there are many options available out there, and there are a lot of solutions. But ensuring that you don't fall foul of SARS or the law, one of the things that can help to do that is getting a proper opinion, a proper legal tax opinion. And it can be extremely beneficial, something we at Holborn do quite often in conjunction with our offshore structuring. It is very necessary. And so, Andrew, if you, for the benefit of those on the webinar today, could give us, explain, A, what is a tax opinion? What is the value of a tax opinion? And why is it important?
Sure. It's a little bit like asking the turkeys about Christmas, and I see we're running low on time, but let me tell you anyway. What you said sums it up perfectly. The world is becoming increasingly complex. Transactions that people are doing, particularly when you go offshore, that's the downside of going offshore, is the complexity. And when you are asked about the tax treatment of a transaction that you enter into, you're going to have to explain it to the SARS. If it's very, very complex, you're going to struggle to explain it to the SARS if you don't have a written recordal of what the structure comprises of, what steps were taken, and what the regulatory impacts were. Simple as that. You have to do your tax return. You have to justify the positions that you adopt in relation to your tax. And unless you're a tax expert, it's very difficult to do that, right? Invariably, when SARS asks a client of ours, why did you disclose your tax in this way? How did you do it? They come to us and we give them a tax opinion, Section 223 of the Tax Administration Act. So that's point number one. Point number two, so being able to show why you did certain things. Some of the structures that you are dealing with are created in fairly grey circumstances from a regulatory perspective. In other words, the law is not clear cut. Even more important, how did I adopt my position? What is the technical rationale? And unfortunately, it's understandable, but it's unfortunate. Clients don't want to do that. And the number of clients that come through my door that have a structure that they either can't explain to me, or they say it has implications that they can't connect the dots on, so they can explain the structure, but not their understanding of the outcomes. Or they give me a document which, when I look in the fine print, or even not the so fine print, says this is not a tax opinion, is astounding. The cost of these things are frustrating, but many of our clients drive nice cars. When they do complex structures, they don't want to pay for opinions. And the long and the short of it is you leave yourself open to investigation and audit if you can't show why you did things. And I have so many clients that come to me and tell me, this is the law. These things don't work. Loop structures don't work. How do you know? Oh, well, I applied for one and I didn't get approval. Okay. Can I see the application? Or can I see what happened? Either they don't have a recordal of it, or they got poor advice, or they misdescribed the transaction. So the nub of it is the following. If you want your structures to be robust, you want them to be evidently robust. In other words, you can demonstrate to SARS or another regulator the how and the why. You have to take a tax opinion. The other thing is you are less likely to be investigated if at an early stage you can show that you did what a reasonable person does, which is to justify the stance that they've adopted in the tax stance that they've adopted. So it's absolutely critical. If you don't do it, you may be lucky and it'll never come back to bite you. If anyone does ask the question, you're going to be doing it at some point, and it's quite harder to do in arrears generally than doing it at the time.
Thank you, Andrew. I believe there is quite a bit of high-profile case law backing the use of an actual tax opinion when it comes to being able to mitigate penalties by SARS when it comes to underreporting. Jeff,
Absolutely.
Yes?
Yeah, absolutely. And, if there's something that's gray or we're not sure of, we go to senior counsel as well. And many of you have heard of using senior counsel. What do? Well, they spend their life in court. So you're getting the transactional understanding of the law from me. And then we go to another professional who A, checks my homework, he understands tax, and B, says, I think a court, if charged with this decision, would be likely to interpret it the same way. It gives you double comfort. And as you say, when it comes to penalties, no one can point a finger because you entered into a transaction and you took advice. That's the most you can do.
Okay, so Jeff, if I can ask you to just sum up and close off.
Yeah, absolutely. Andrew, that last point you made, I think it's so crucial that you don't do it retrospectively, because then, it's just one, you're doing it under pressure because you've probably got the authorities on your back and you're trying to get it done. So, clearer heads would prevail if you do it right at the outset with a very clear understanding of what you're trying to achieve. But Matt, thank you so much for hosting us so eloquently. I think you guys have heard it a few times today, but Benjamin Franklin, he had that very common anecdote: when we fail to plan, ultimately we are planning to fail. We don't want to always look at things this way, but we do need to plan with the worst circumstances in mind. Today, I hope was insightful to give you an idea of what the rhetoric from SARS and Treasury side is. And these aren't just rumors. These aren't just ideologies of a socialist government. These are, many of them have the potential to end up in our laws. So reality is we can't avoid them, and we must do what we can to prepare and protect our wealth. Our message to our clients and the families that we help has always been: pay your taxes. You're a citizen of a country, pay your taxes. But if you have an opportunity, for all the reasons that we've spoken about, offshore a portion of your wealth and use legal structures to remove this wealth from your personal or from your person, to limit those taxes that you do not need to pay. And there's absolutely nothing wrong with that. I'll say it again. There's absolutely nothing wrong with using current legal structures and the current legal framework to limit the taxes that you do not need to pay. And a part of this is creating an environment for you to safeguard and grow that wealth as tax efficiently as possible, amongst many other reasons. But the trick is to do this without falling foul of the laws and the standards and the reporting responsibilities, as Andrew pointed out. So we're a little bit over time. Thank you all so much for attending. Matt, again, thanks for hosting. Andrew, your insights always so fantastic. We will be in touch with our clients and the people that have been on the call for a bit more of a personal conversation. Have a great week.
Thank you very much to everyone. Cheers, Andrew. Thank you, Jeff.